gentlemen. It is a privilege to address you this morning at VC Circle's debut edition of the Family Office and Investment Summit 2014. Waterfield Advisors is an India-focused boutique firm that provides full-fledged advisory services to family-owned businesses. We do this under three broad verticals, which include the multifamily office services, corporate advisory services, and alternative asset management services in private equity and real estate. As many of you would be aware, the modern concept of the family office developed in the 19th century in the US. In 1838, the family of financier and art collector J.P. Morgan founded the House of Morgan to manage the family assets. In 1882, the Rockefellers founded their own family office, which is still in existence today and provides services to other families. The expression family office covers all forms of organizations and services involved in managing private fortunes. These can be organized either as family-owned enterprises, in which the family wealth is pooled, or as companies or divisions that provide financial services for these clients while the family still retains the decision-making powers. Many family offices begin as single family offices. In these cases, the family is the owner of the organization and uses its services exclusively for itself. However, in the course of time, in order to avoid one family having to bear the very high operational costs associated with single-family offices, families often decide to offer these services to other families in their network. These then morph into multifamily offices. The multifamily office's greatest strength is its ability to deliver coordinated advice, services, strategies, and solutions tailored to a family's unique needs. Primary services include financial planning and investment-related services, management of complex assets, accounting, tax planning, asset protection, risk management, charitable giving, and also management of closely held businesses. Families in a multifamily office avoid paying the layered expenses of individual providers and benefit from lower costs while receiving superior personalized services. Family offices today are arguably the fastest growing investment vehicles in the world today, as families with substantial wealth are increasingly seeing the virtue of setting up such entities. It is difficult to estimate how many family offices there are because of the various definitions that one uses for a family office. However, it is believed that there are at least 5,000 such entities in existence globally, at least of which half have been set up in the last 15 years. The first panel discussion today focuses on the emergence of family offices in India and the latest trends in this particular space. I would like to share with you a few observations in this context on why in India the family office space needs greater understanding and is also becoming an area of growing interest. Firstly, wealth creation in India is fast growing. Over the next 10 years, there will only be 3 countries apart from India, which include the US, China, and Russia, that will have more billionaires than India. The number of center millionaires, or millionaires with more than 100 million in disposable assets, is projected to double from the present 383 families in India. 85% of India's wealthy today are entrepreneurs, with the business and personal wealth of family business owners inextricably linked. Family office structures enable a clear delineation between corporate entities and personal aspirations, thereby enabling individual family members to pursue their diverse personal goals. Thirdly, and often an unfortunate drawback of wealth is in fact the ability for it to cause conflict, and in the context of succession, family conflict. By some accounts, India has the highest incidence of family feuds. 40% of the global wealthy have direct experience of their family fortune leading to disputes. But in India, an estimated 60% of the rich have seen relationships deteriorate because of feuds over money. Family office structures can be an effective tool to manage intergenerational wealth. Family offices are also a very important source of new capital. Over the past 5 years, research has indicated that family offices represent increasingly appealing sources of capital for hedge funds, for private equity funds, and for investment banks. There are three critical forces which are actually driving this emerging trend. Firstly, family offices typically represent significant pools of wealth seeking investment returns. Secondly, as demand for integrated wealth management services has increased, the rapid proliferation of the family office model has in fact deepened the sector's resources. And finally, family offices tend to have a long-term investment horizon that make their assets sticky, helping to promote fund stability. With many aspects of their long-term planning tied to their investment portfolios, more families are finding that family offices represent the ideal structure for implementing a cohesive wealth management strategy. Family offices also share many characteristics of pension fund investors, and these similarities is actually driving to serve and reinforce the trend towards institutionalization of this industry. As my next observation, more than 50% of family offices own an associated family business. In such situations, a disproportionate part of a family's wealth is concentrated in an often illiquid family enterprise. In this scenario, most families see the business solely as an operating entity and their other assets as investments. As a result, different investment paradigms and objectives are utilized, and the family enterprise asset class is managed separately from the family's wealth portfolio, in certain circumstances resulting in underperformance. It also exposes the family to risks which are often unforeseen and unpredictable. The inevitable consequence is the silent and unseen evaporation of family wealth. Lastly, a nascent but growing trend amongst family offices is the interest in socially responsible investing, with programs being developed around customized restrictions as well as preferred responsible investment options. Next generation family members have a growing interest to align their investment objectives with philanthropic values. The lines between growing wealth and doing good deeds with that wealth are no longer two separate agendas. The ensuing panel discussion and the larger conference today will pick up on many of these themes. At Waterfield Advisors, our endeavors to assist families as they work through their unique characteristics and circumstances and to offer them clarity and a holistic perspective as their advisors. As you can see, in terms of our first panel today, we have some wonderful distinguished panelists, and look forward to the discussion that we will have on the emergence of family offices in India and the latest trends in this space. Thank you. Which is really, how have you seen, Amitabh, the role of the family office evolve over the last 10 years in India? And what do you believe are the scope of these services in India today for a family?
Yeah, thank you, Soumya. It is always very, difficult to start the session like this, but thank you. India, I think that family office concept is very nascent, according to me. As she just now said, Rockefeller family in the US, it started some 150 years or something, JP Morgan. But in India, it is fairly nascent. Having said that, in India, what we have seen that in many business houses, it started as a kind of offshoot from their main business. Somebody who is trustworthy in the family, managing the finance of the business, he was also given the chance to manage the investment. But from there, I think over the last 10 years, we have come to a long distance, and today the concept of family office is very much well entrenched. As Sahat said that some 40 families in India probably having $15 billion. So I think at least they know about that thing. The concept of family office is very different than a typical wealth management or typical asset allocation, etc. Most of these business houses or the entrepreneurs, for them preservation of their wealth for the dynasty, the future generations, that is very important. And hence, in my experience, what I have seen working for the Kimji family in Muscat is that extreme patience I have seen in these families. They are not really looking for day-to-day return. In their own business, they do take risk. That's why they are entrepreneurs. That's why they have made wealth. but they don't want to risk that will because those are for the future. So the concept of family office has to take account of that. Now the point that comes that what is family office? What is the understanding of the family office? In many cases I have seen that this is very delicate definition, and in some cases I have seen a blurred kind of understanding. A family office might might start as an administration of the family wealth, but today it is more seen as a gatekeeper, the conscience, the family values and the wealth preservation. That means whether a family office is a manager of the manager or the family office is putting himself in the shoe of the family to select the manager. It is very delicate differentiation, but it is very important differentiation. I think today in Indian context, if we see, because the global context is very different, Asian context is very different, but in the Indian context, I think that multi-family office is something which will be the need of the hour going forward, because you need, internationally you need about 500 million plus to have a single family office. In Asian context, probably that will come to about 100 million to have a single family office, but less than that, probably a multi-family office is very important. So you have to have outsourced family office concept for the families. Now the point that comes in mind that what would be this outsourced multi-family office managers should offer. I think the whole concept should stand on the three pillars, that is the depth of the service, the breadth of the service and the relevance of their service. Again, we have to make a distinction that it is not a private banking of one Credit Suisse, for example. It is not that. The concept is that it is so, the regulatory aspect, the tax aspect, the legal aspect of managing the wealth has become so rigorous. Compliance has become so rigorous. So anybody who is giving an advice to the family has to have the depth. They should be the master of what they are saying, number one, and the breadth of the service that they are offering. It cannot be only one service and that is what they are offering. So I don't agree to the concept of a boutique multi-family office manager kind of concept. I think it is necessary that they have to have a full service offering, and the relevance is very important. Ultimately, the family who is engaging them, they must find a value and they are eager to pay. It is a misconception that the families, they are not paying, something like that. I have seen that as long as the interest is aligned of the family office manager, multi-family office managers and the family, they are willing to pay, provided the the upside is shared like that. I mean, but of course we have seen the fee-based model, etc. But both coexist. So it is not one size fit all. That is my understanding, and it has come long way in 10 years, and more to go in India. Huge scope, according to.
Thank you, Amitabh. Appreciate your opening comments on that. My next question is actually to Radhika. In terms of when should a family consider setting up a family office, and what are some of the common challenges that families can expect when they have to come up against setting up a family office?
Sure. Thank you, Soumya, and thank you, Amitabh, for laying the ground for. The obvious answer to the first question is when the family asset size, that is the size of the investable assets, reaches a particular minimum. I mean, as a thumb rule in the Indian context, I might offer something like 500 crores, because below that, I think, one can make use of the services of the various wealth managers and other service providers that exist in this ecosystem at a far lower cost. But I think an even more important criteria is the objective of the family. What is the objective really in setting up the family office? Once, and I'll talk a little bit more about that when I get into the challenges, and whether that is agreed upon by all the people involved in the family office, such as the person who made the wealth, who created the wealth, and the various family members involved. So getting the objective straight is one of the most important things to do, even before I think you reach the asset size. The challenges of setting up a family office are first and foremost finding the right people or finding the right person to run the family office. As Amitabh mentioned, a person with the right breadth of experience, of knowledge, whose objectives, who can relate to the objectives of the family. And right now, I'm not sure that the ecosystem is fertile enough to have such a large depth and breadth of professionals available in India. Because, as has been pointed out by both Samya and Amitabh, this is a nascent field. There's been a lot of wealth which has been created in the last 15 years by entrepreneurs who want to move away perhaps from the businesses that they created and focus on other things. They have to also balance out the needs of the various family members. They also have to balance out the need for creating income versus capital appreciation of the business. I think that the first objective, the minimum objective a family office should have is really about wealth preservation. This is of particular import in India, which is in general, Indian economic history has been a history of high inflation. So, and I'm not talking about WPI inflation over here, I'm of course talking of urban inflation. So the minimum objective should be to beat the rate of urban inflation, roughly forecasting over a 5-year period and beating that particular rate. The other objective should be, as I mentioned earlier, to balance out the needs of different family members, to keep money for perhaps to invest in new businesses as well, and also income generation and capital appreciation.
Great, thank you, Radhika. And I guess picking up from Radhika's comment on wealth preservation being perhaps one of the key attributes of a family office. Naren, from a fund manager perspective and chief investment officer or a large fund house, how should family offices be constructing some of their investment portfolios, given that there are obviously very divergent views and different needs for different family members?
One is there's a basic expense or need for different family members, which has to be satisfied through conservative investing. But in the rest of the money, there is a much more opportunities for family offices. And particularly if you take a country like India, barring insurance companies, most of the other people tend to be pro-cyclical. So they tend to buy when you get money, and you get money normally at the wrong time. So family offices have a superb advantage in being able to identify different asset classes in different years, which become very, very attractive. Like if you take the world as it stands today, 2012 could have been international investing, 13 would have been during the crisis Indian investing, and maybe now it could be long-term gilt investing. But I find that, it's a tough task for people because, they are the family offices are the few people who can actually invest with a long horizon. But somehow they measure themselves on very short horizons, and therefore they don't make use of the superb opportunities that volatility presents itself. So I think there is a lot of challenge. Maybe family offices need to create what they actually want to do in investments as a philosophy, and then use the volatility presented by different asset classes to buy cheap. And I think barring the insurance companies, I believe that it is only family offices who can make use of the different opportunities that the markets present itself. I don't think it can be the small investor or the medium-sized investor who can make use of this volatility, because their need for income is much higher than the family offices. And I think there's a lot of way, from what my interactions with family offices, they can substantially increase their risk to the most undervalued asset class at a point of time. And they can make a lot of money by that. And I find it that they're sometimes looking at the next 3 months or 6 months, when they don't need to look at it at all. They can identify an asset class which is very cheap, and sometimes I find it very interesting that through the last 3 months, most family offices that I interacted with agreed that tax-free bonds are very attractive. But I told them invest the same thing through long duration mutual funds. They said, no, we won't invest. Although the underlying experience that they are likely to get in both these asset classes over the long term will be the same, they were willing to invest in tax-free bond, but not willing to invest in long duration guild funds, for example. So I think there's a lot of opportunity. As everyone has been saying, we are in the initial stages. There is a lot of learning that we have to go, and maybe like Swensen, who ran a Yale endowment successfully, there are going to be people in this room who will become the Swensens of India, and some of them will have to take lonely paths at different points of time to earn very big returns for their family offices, leaving aside the amount set aside for regular expenditure.
So would it be fair to say that this is an emerging different set of investors, different from retail, different from institutional? And would fund houses be looking at them differently?
Yeah, we would love to interact with them, provided they are able to not think for the next 3 months, and they focus much more on valuations and the opportunities that the market provides. But if they think like a high net worth investor who's looking for the next 1 year, then what happens is we will start interacting with them the way we interact with the high net worth investor. So the opportunity is for people in this room to decide how they can handle money for the long run, and how they can handle money for the short run. And I'm sure there'll be some successes which will come out, and then people will then realize that they have to follow the success stories.
Fair points. In fact, this probably leads quite nicely into my next question to Parag, which is really in terms of sitting in the private equity world of a promoter-held organization. How successful are business families when it actually comes to making astute investment choices regarding their investments into other business sectors, and what is some of the value that they actually add? And are there any anecdotes from your experience at Mahindra Partners that you could actually share with us?
Sure. Yes, I must confess, Sonia, that I am an outsider to this group because this is my first session on family office too. But just hazarding a guess from what you asked is the promoter-based fees, right? I'd say there are really two extremes of promoter-based fee. At one level, you will find, to use a technical term, somebody who is going to be an anchor investor and say that I will bring in other LPs and I will hire a professional GP setup to manage the business for me, and I'll still be a promoter-backed fee. On the other extreme, which is a little bit similar to what we do at Mahindra Partners, is we decided that we're actually going to be all proprietary books. Everything that we have, all $1 billion that have been deployed, is actually the Mahindra Group. And when I say the Mahindra Group, it's not only the promoter, but it's actually all the shareholders, every stakeholder. It's a publicly listed entity. So there are these, so we actually, if you now look at these two extremes, and if one were to toggle between what are some of the values or what are some of the insights that the family brings in, I would say that look at it almost like a supermarket. There's a menu of choices. I'd say first and foremost is clearly the deal flow. And at least I know that at the Mahindra Group and at some of the other business houses that are there, which are reputable in India, you find that they're actually the first stop for anybody wanting to get an investment, because there's a reputation, there's a credibility that is attached. So I find that deal, in fact, I get most of my deal sources from Anand himself. He'll get an email or somebody will give him a call, and then that email will come down and say, Parag, should we be evaluating this? The second one I'll clearly say is domain expertise. And therefore, if you are going to invest in the sectors where you have some experience in and you want to look at adjacencies, then clearly that comes along very well. In some sense, even if the domain expertise is not direct, the whole networking element. India is a small community. It means you probably find that most people in this room will know each other to some extent. So it is a close-knit community even at the family office level, and you find therefore it's very easy to network. The third element, and this is possible again in the more Mahindra Partners model, we actually put resources. So we don't hesitate to take good resources from our main core Mahindra Group to actually help some of these businesses kick off. So if we are starting up and if we are doing something, we find that very convenient. Again, there is no conflict of interest because it's all proprietary book money represented at the group level. And so here in the Mahindra family case, they have decided not to dissect a family office separate from, in some sense, what their core business or the core companies. And that's, again, it's Anand's, it's Keshav Mahindra's philosophy. Clearly, I'd also say that there is, and you know, in Mahindra Partners, you asked me for some anecdotes. Even within our setup, I'd say that we actually have different governance models. So, and this is, and I think both Radhika and Naren referred to this, it's the objective, and this is where I'm trying to relate to the family office, is very important. Because if as a family you decide that you want to be involved, I'd use the word interference as a positive thing, then the business model and the governance model that you need to set up is very different, and therefore you need to hire a team that is relevant to that effect. On the other hand, if you say that you just want to put the money and let somebody else run the show for you, then it's different. And even within Mahindra Partners, we have many companies where we actually as a group or as partners are very involved and we actually run the show. We'll even bring in elements of Mahindra, and there are some where we've made traditional third-party private equity investments, and it is then on a pull-based model and not on a push-based model. We just wait for that portfolio company to reach out to us and say, hey, these are the 3 things of support and can you offer that? So I'd say that there is, between this menu, you really have to toggle and see, you know, how you can bring in the synergies.
A question for Amitabh, for you now, in terms of how should successful business families really distinguish between how they handle their operating businesses and how they actually manage their personal and family wealth?
Well, very difficult to say how they should, because I don't like the word should. I think Parag has actually mentioned a lot of things, the way these family offices should do these things, basically the governance and the parameters, etc. I think I have seen again from the experience that 2 distinct models. Some promoters, when they sold out their business, a kitty wealth has been created, and they want to preserve that for the next 2-3 generations and forever. But still, entrepreneurs are risk-taking. So still they want to incubate many other businesses, okay? And so that is one model. So they will be then investing in, some companies which they think that they know, and the managers will be allocating the funds, and he will be quite hands-on in that way. On the other side, again, taking Parag's view, that totally hands-off, the wealth has been created, now the goal is to preserve and philanthropy, etc. A manager is allocating and taking the whole thing forward. I think, again, the distinction is that, and I am telling it, I think I am repeating myself here, that it is very patient capital. I mean, long-term, absolutely, a true family office and a true family office will never look for day-to-day Bloomberg pricing or etc., which all of us do. But they are really long-term and they really want to preserve their wealth. In their own business, they take sufficient risk. They cannot risk the wealth that has been created, for putting in other places. So 2 models. One is that hands-on, which is whatever the circle of experience the promoter has or the entrepreneur has, incubating many other businesses on that, assuming that probably 3 or 4 out of 10 will succeed and make a WhatsApp kind of return. On the other side is that hands-off, philanthropy, the family goal, etc., and one manager is maintaining the portfolio, which is a portfolio approach.
Great. My next question is to Radhika, really taking a point from Naren's earlier comment that family offices are not really kind of making use of or are approaching investments more from an H&I perspective rather than a longer term investment. What are some of the asset classes that family offices are looking at right now, given your experience of where you are, and how different are some of the asset allocations, and really is there some way in which will counter what Naren is saying in terms of the fact that are family offices really thinking longer term or not?
Right. Well, the family office that I work for is somewhat unique. It fits into one of the categories that both Parag and Amitabh mentioned. This is the family office of Hemendra Kothari. He has been in the financial markets for over 40 years now. So it's pretty hard for someone like me who perhaps has about 10 or 11 years experience really dealing with India to actually counter, whatever the experience that, that he brings to the table. So he tends to be more of an involved person in the family markets. And certainly there is a perspective of both integrating the short term and the long term. But to counter what Naren is saying, one of the major investments that family offices, Indian family offices have is real estate. And very often this takes the form of investment in land, admittedly with an eye towards use conversion. It also takes the form of lending to promoters. That's more of a short-term sort of thing, lending to developers. That's more in the 6 months to the 36-month kind of time frame. But there's also, in terms of generating income, looking to invest in properties, commercial and residential properties that can be leased out. The second asset class is, of course, in the public markets. And very often, apart from investing in mutual funds and sort of generally participating in the beta of the market, there's also an interest to take significant stakes in public companies. Perhaps not enough to get a board seat, but at least 5 or 6%, something of that nature, where there is a view to the long term. Because a family office cannot risk being taxed necessarily, depends on how you're structured, of course, as capital gains as business income. The last thing that I want is for the tax person to land up and say, you're trading, you really should be taxed at business income rates. So that itself lends a somewhat of a long-term orientation to, timing of entry, etc. That may influence some that may, lead to some short-term thinking. Right now the markets are too rich. I think I'm going to wait for 3 months. But it's really not. It really doesn't sort of govern the objective for which you're doing something. Then there's of course fixed income, debt mutual funds, FMPs, and so on and so forth. And then there is also many family offices, because wealth has been created by entrepreneurs who've been hands-on in a business, is to invest and take significant stakes in an actual operating business. I think it may be well known that, for instance, in the Kothari family office in DSP Investments, we have a fairly significant stake in a retail operation in South India, Health and Glow and Foodwork. We do have a significant stake in that. So for instance, which is very different from running an investment banking business. The fourth thing is, of course, the whole alternative investment space, and in which I include also the structured transactions, some of which could be short term. That we are presented many opportunities by the various wealth managers who are constantly contacting us, but also the opportunity to invest in private equity funds, real estate funds, as well as in hedge funds. Of necessity, these do require a longer term perspective, because when we are invested in a private equity fund, the typical time frame is 5 to 7 years, if not 10.
Great. Thank you for that perspective. A question now to Parag in terms of, as wealth gets created amongst families, many of the next generation sometimes start looking at new business verticals and new businesses to get into. So could you just share some of your thoughts on how maybe some of the business families should actually leverage the brand equity that they've kind of built into new business verticals that they may actually be looking to get into?
So I would say, Sonia, again, it has elements of my earlier conversation. Brand, I think, again, in India, you find that there is a strong halo around the brand. I mean, most of us will walk around and find that if there is a last name and there is a trust associated with it, look at a product, means look at a group like Tata's, right? How many places in the world you can have an enterprise like in Tata that can be into everything from a consumer to an IT to an infrastructure, but there is a brand, there is a trust associated. Same is true for some of the other groups, including the Mahindra. So I find that if you have nourished that brand over these years, over these decades, you have to actually be very careful on how to use it. And many a times, in fact, and that's why I said that, in going back to even Amitabh's earlier comment about how you have to be careful about deciding whether you're going to be involved or not. So if there are investments where we will be having a significant majority, where we have management control, the Mahindra Group will be willing to lend that brand. Because with that brand opens up a lot of doors, brings in credibility, consumers are able to feel comfortable. So some of the new brands we've launched, say a Mahindra Retail, we actually have put in the brand name, but we still have our own thing calling it mother and child, it's mom and me. On the other hand, if there is an investment where you are not going to control directly, you have to be very careful. And since your question was around how, as the next generation go out there and incubate new businesses, I think it's a fine line, it's a gray line as to when that brand name should be lended. Because if you lend it too early, and at that point you find that it's not working out, then it can actually have a negative effect on the mother brand itself. But if it is something, means, if you look at some of the newer businesses or newer verticals, and a lot of the kinds are doing that, I think it's very useful because it gives them, I'd say, at least 5 years of an early start, the minute you have that card attached there.
Great. Thank you very much. I'd like to thank all our very distinguished panelists for the opening session today. Thank you.